This is the Wealthy Investor Show, where we don't just talk about your wealth, we also talk about your holistic health. I'm your host, Mattias.
And I'm Erica.
And this is the Wealthy Investor. Welcome back to the Wealthy Investor. Unfortunately, it's just me again. Erica is with the kids. This is going to probably be a reoccurring theme for all the podcasts that are recorded in the summer. The summer months are a little bit more challenging. We haven't been able to figure out childcare for everybody every single day. And then, of course, things happen, like kids get sick and schools close, holidays, all that kind of stuff. So, I had the opportunity to interview Jim Manning. Jim Manning is out of St. Louis, and he is a broker. He is an investor. He is primarily an investor, and he operates funds for lease option kind of deals. So basically, people will invest with him. He offers a preferred rate of return. With that capital, he then helps people buy houses that are not able to quite obtain financing in a traditional route. Now, that typically, it looks like somebody, maybe like a new business owner, where they haven't done their business for 2 years. They could be making great money. They could be making hundreds of thousands of dollars a year. But if they haven't done it for 2 years, they are not lendable at that moment. So what he does is he helps bridge that gap and provides them ownership in a house where the repairs are their responsibility, et cetera. And then the goal is for them to eventually buy the property at the end of the day. So it's a really cool strategy. It's really cool that you can invest in that kind of thing. It's a very passive investment. You'd likely need to be an accredited investor to be able to do that, but we will talk more about that. Something that we actually talked about off air that I wanted to chat with you a little bit about now is your why behind doing everything. So Jim told a story about how he was he worked for a billionaire when he was very young. And at first, that billionaire was, his role model. Like, wow, this guy has it all. He is old. He is big. He has a gorgeous supermodel girlfriend. He flies around in a private jet. They were drinking, $1,000 champagne bottles in that private jet. Seemingly had it all. But the more that he got to know him, the more he realized that guy really did not have his life figured out, because his family wouldn't talk to him, and he was just miserable. And so at the end of the day, don't get lost in the journey. If you are trying to build your wealth, your kingdom, if you will, don't get lost in what's really important. And I think that it takes a lot of intentionality at the beginning of the journey to really define what you want. And then it takes a lot of, intentionality throughout the process, because you could find yourself, so focused on how you're going to have a great life once you just get this next rental property, or once you get, financially free, once you become a millionaire, once you become a multimillionaire. Like, whenever those things happen, then I will live my life. And reality is, you got to be living your life every single day, because we don't know when we'll die. We don't know if one of our family members will die. We really need to be present for them at this moment. And so that was a really good reminder of, somebody who has achieved so much and everybody looks up to and thinks they're living the dream, and really they're miserable. And I'm not saying that all rich people are miserable. I'm just saying you need to be, no matter how wealthy you are, no matter what you're trying to do, you need to be intentional and not take things for granted along the way. This is a great information podcast about syndications. We get into a little bit specifics about how one could invest as a realtor and some of the advantages that realtors have. So definitely, if you are an agent and are considering investing as well, it's a really good opportunity to listen, because there are passive, very, very passive. I know people say that rentals are passive income, but really you are working on those rentals. You get calls, even if you have a property manager, there is some work to be done with them, not pure passive. When you get into these kind of syndication or fund deals, you are analyzing the deal, you're analyzing the strategy, you're analyzing the person, the operators behind it. You invest the money, and then you really don't do much other than collect checks and potentially get tax benefits from it. So, really interesting story. I think that financial literacy is something that's so important for people as a tool to live the good life. And the good life is again defined much more broadly than just wealth. So without further ado, let's listen to Jim Manning and on this episode of The Wealthy Investor. Welcome back to The Wealthy Investor. I am here with, I found out, broker and investor Jim Manning. Jim Manning is out of St. Louis. Thanks for joining us.
Oh, thanks so much. I really appreciate it, Mattias.
Hey, where are you focused on in your real estate investing currently?
Oh man, that journey's been a lot. So we've done a lot over the years. We started out doing short sales, and we've done that. We've done flips. We've done, and then currently we're doing a lot of lease purchase deals, is what they're called, as well as hard money lending are kind of two of the main strategies that we're using right now.
Awesome. Well, tell me your journey. I've heard a little bit about it, but yeah, tell me how you got to this place and how you started.
Yeah, absolutely. Well, thanks for asking, man. So I started out as a 22-year-old. I got licensed, and I got my license just to run comparables. I didn't want to trust a realtor to do that for me, and he wanted to be in control of that. And then we fast forward to today. We've there's three companies that I founded and two real estate funds, and we've actually done over 3,500 deals when you collectively through our agent team and the investments and everything like that. So I know all about being an investor agent and what it takes to kind of be able to live in both worlds. And we got our agent team got up to like a top 10 team in Missouri and Illinois. Uh, Kind of in our heyday when we were doing the big most amount of agent deals that we had ever done.
So you were focused on residential sales at that point?
Yeah, residential sales. That's right. And I fell in love with real estate investing because um, I was at a corporate America job and I was pushing paperwork, and it didn't matter how good of a job I did. There was like no value. One month, my boss, I worked my tail off, and my boss didn't notice. And the next month, I slacked off, and my boss didn't notice. I was like, okay, like I need something like that's a little bit more valuable. And if you think about real estate investing, we're taking a neglected piece of property and we're putting money into it and improving it so a family can live there when you're flipping a house, right? And I just fell in love with like literally improving a piece of the world and creating homes for families.
I've heard some people talk about that as a recycling a home, which I think is an interesting way to look at it. But also just that it's a great feeling just to see it transform, and then to have somebody super excited about living in it is really great. Yeah, sorry, keep going.
No, that's right. And so then we started doing a bunch of flips, and the one thing that I would say to like of note, guys, is like if you hear the 3,500 deals, it's like, yeah, that's a lot, but we have a team of over 30 people now, and it took me 18 months to do my first investment deal. So if you're just exploring this and getting into it, I mean, it took me 18 months, and there's a lot of things that held me back on that, and a lot of challenges that I had. But really the biggest one was as a 22-year-old kid, I was too afraid to reach out to people and admit that I didn't know. And I thought that studying courses and buying courses, studying things online was going to get me there and get me into some knowledge. And really, what happened was it created a situation where that's analogous to if I wanted to be a really good free throw shooter, buying a book on shooting free throws and just reading the book, never going to the gym and actually physically taking a practice shot or much less shooting one in the game, right? And so like there's only so much like educational learning that we can do until it starts to go in one ear and out the next. And I was just reading through one course and forgetting about the last course that I just had completed, and just in this information loop. And
Analysis paralysis, I think, is a great way to say it too, right?
yeah, and education without implementation is really just a form of entertainment. Like there's no actual value to it if you're not doing that. And then Ryan and I, Wessels, we ended up partnering on businesses, and then we end up bringing in, we got 130 now limited partners in our 2 real estate funds. And, it just kind of snowballed from there. And uh, I guess the rest is history on that.
Yeah, that's
So,
awesome.
yeah.
What do you, I think oftentimes people when we're taking on their first deal or trying to get out of that, analysis paralysis, if you will, just gathering more information, not taking any action. I think oftentimes people assume that their decision is going to be a zero sum game. So like they're going to invest $200,000 in a property, and if they don't do it perfect, it's going to lose $200,000. But really, sometimes in a really bad deal, you might lose. I mean, of course, it can be worse than this, but like if you do your numbers, if you're reasonable, if you're actually underwriting property, you might lose $5,000 maybe, right? In a really bad deal that you've done a lot of due diligence on, and that's a bargain for probably the lesson you've learned.
Well, I mean, yeah, he's definitely right. There's more fear there now. I mean, I've lost a lot of money on deals before, more so than 5,000. But I mean, out of 3,500 deals, I think there was a deal we lost 100 grand on. Um, but one out of the 3,500, and that loss happened in part because of the volume that we were doing. When you get to a certain volume, you have a little bit less control over it, and then a mistake can get magnified because not only do you have that one project, but you have 240 other ones that you're working on and balancing and everything like that, right? Um, so I mean, I think so what's interesting is I think there's a step that everybody misses when it comes to real estate investing, and I don't really I haven't really heard anybody else really talking about this. So if I can give some, hopefully in my mind, some thought leadership for you all here. Um, and the first step I think to investing in real estate it comes through like a self awareness of who you should be. Okay. Now, for example, like out of our 130 limited partners, many are financially free, and the top 10% are making more money than almost all the full time real estate investors that I know. And guess what? They're spending 0 hours a year doing it. The difference, though, is that they have a very high net worth and they have multiple millions of dollars to invest into passive vehicles, so that other people can do the work for them, and then they generate a return that way. So, well, the first step, really, when it comes to investing in real estate, is thinking through, like, are you more of a passive investor, or are you more of an active investor, and which one is best? Which one's best for you? So, like, for example, before this call, I just sat down with a programmer guy, and I asked him. I said, "Hey, what are you making? Are you making good money? Are you happy with the income that you're making?" He said, "Yeah." And I said, "Do you enjoy it?" He said, "Yeah, I do really enjoy it, actually." Um, and then he starts talking about, "Hey, well, maybe I should scale a real estate investing business." I said, "Well, do already enjoy what you're doing? You're making really good money. If you were just starting out in your career on day one, like, would you be making close to what you're making now?" He said, "Oh, well, no, I wouldn't be." And I asked him, and I said, "Well, you just mentioned that you want to scale a business or scale your investments. Are you okay with saying no to your full-time gig right now that's, you're making over $100 an hour on? Um, and you're able to, instead of doing it at 8 hours a day, you're so good at it, you can do it in 5 hours a day, and you're able to make that kind of money." And he said, "Well, wait, what are you talking about?" I said, "Well, if you scale an investing business, you're now saying no to your full-time gig that's paying you over $100 an hour to do. And just so you know, starting out as an investor, you're not going to make close to that income as you're starting out, because you're starting a new business. It's like you're a freshman in college all over again, right?" And so he started thinking about it, and we had a really nice conversation, and the end result of which was, "Well, no, why don't you be a passive investor and work at your expertise, pour more hours into that, find out a way to make $200-$300 an hour into like your programming expertise. But then also learn how to be a passive investor. There's real estate funds or syndication deals out there that you can learn how to invest in a passive way, get all the benefits of being a full-time real estate investor, but in a way that actually generates you passive income, not a way that is a theory of generating passive income. So so I don't care if you're a programmer. In this case, that's who he was, or a realtor. There's a lot of mega agents, like producing that are making over $1 million a year agents that maybe you love the idea of investing, but that might take, but to then turn around and start doing flips and everything like that could be a pay cut for you, right? So, so I think there's a formula there on like, do you have the time to take on opening up a new company? If you are, do you have do you like what you're already doing, and then when you when you kind of factor that in, then it kind of becomes clear, okay, like, should I go down the passive route or the active route?
That's yeah, very, very well said, and I agree with you completely. And I think that depending on your stage as a realtor, if you're just getting going, if you're an agent, you're just starting, you probably don't have the net worth, you probably don't have the income to do passive type of income investing, and you might do something that also doesn't take that much focus from you, and that would just be house hacking. Like, if you're young and have flexibility, buy a house, see if you can rent out part of it. If not, as soon as you're saved up enough money to buy another house, rent that first house out, rinse and repeat, and then slowly build up your net worth, establish yourself that way. And that doesn't really take a ton of thought. And from there, you could open up maybe a flipping business. Once you have equity, you could tap into. You could get more interested in other investment portfolios, and you can also just start investing passively, like you're talking about. But can we talk about kind of what that looks like, what a syndication is, what an LP is, a little bit, so for people that don't understand or haven't heard about this terminology before?
Yeah, absolutely. Good question. And guys, for the record, like I'm an active investor. I started out actively investing, so I'm not dogging on that. Like,
Right.
that's a good opportunity, but it's an awareness of who you are. I was a 22-year-old kid. I had a $0 net worth when I started out investing in real estate. I didn't have a penny to my name to invest into these passive structures. These passive structures, if you have a high enough net worth, you can make, like, I mean, literally, I could make you six figures of passive income with an hour of work. If you have $1 million plus to invest, right?
Yeah.
But it's the value add of having the capital to throw into it.
Right. You got to get there.
Yeah. So as far as the real estate funds and the syndications go, there's a couple nuances and differences to them. Think like the United States of America and Canada are both in North America, right? But they're two different countries. So a syndication is kind of the same way. They're both alternative investments that you can do, but the syndication's a little bit different than a real estate fund. Okay. So the real estate fund, what you do, in our case, we have in our first fund that we have that, depending on when this recording launches, may already be closed out by the time you hear it. But we have a group of 65. It's called limited partners, but basically just private individuals that are investing into the fund structure. Okay, so there's 65 limited partners, and then there's also general partners, which in my case, I'm the general partner, and we have 5 total general partners. Okay, and it's on us and our company to do all of the work and operate the real estate deals. So the limited partners come in. The word "limited" is a really important word because it means that they're not making any decisions, and they're just very much passively investing. It's on them to provide the capital and not do any of the work. And then on the general partner side, it's on us to do all of the work. Depending on the deal, there may be capital that is brought by the general partners too. It just depends on the structure. You'll see sometimes general partners will bring money, other times they won't. And so in the fund structure, everybody comes together, and then that entity will buy multiple real estate deals. Okay, so one entity has multiple people in it, and then you may go out and, in our case, in our fund, there's about 130 houses in this fund. So one structure, multiple people are in one structure, and that one structure owns the 100 plus properties. Okay. Now, a syndication deal is similar, and that is a group of people investing together. They can have limited partners and general partners, just like I explained earlier. But a syndication would be one syndication per one deal. So it's not very common to use that on single family real estate because you're not going to group grid every time you buy a house to get like 5 or 10 investors into a syndicated deal, and then to do five or another syndicated deal where you need 5 to 10 new investors on one deal. Like it's just not quite at that scale. So it's common to see syndication deals on like a $10 million apartment complex. Uh, so like when it's, when the deals get bigger, then the syndication can make a lot of sense. But then you're not going to buy with the syndication deal. You're not going to buy another apartment complex. That you would put together, draft new legal documents, put together a new partnership with new investors or some of the same old ones, and then now you'd have syndication deal one for apartment deal complex one, and syndication two for apartment complex two, and then that's how you would do that.
Sure. No, that makes a lot of sense. Now, let's say I am a multi-million dollar producer. I earn, let's just say, $500,000 a year, and I really know I should invest more in real estate, but I just don't really have the time. Um, and I hear about a service like you have, so a fund or a syndication. What would be my job? What would be my job to invest wisely?
Yeah, so whenever you have these deals, like you do want to enter into you're entering into a relationship with people, so you want to get to know them, and there's a lot of key risk factors that go into this. There's what the overall real estate market's doing is important to know. There's key person risk. Like, are you investing into an established company? Are you investing into like one or two general partners that have never done this before? Um, so that, and then the actual investment strategy itself, and what the likelihood is as well. So, for example, just to give you, I'm going to put my investment hat on and how I like to think about deals. So, and I know this from truth. At one point, I had 15 vacation rentals, but let's just talk about vacation rentals. Okay. So, on a macro level, okay, like what is the overall like the investment strategy? There's some big pros to vacation rentals. A lot of people have made a lot of money in them. Um, I think that's kind of like an obvious thing. I think a lot of people understand the pros to it, but from a risk standpoint, there's a couple things I don't like at all about vacation rentals. Okay. First is controlling the real estate of the vacation rental marketplace. So I have a property in St. Louis City it was generating us in its heyday about $14,000 a month gross, was what we were grossing per month, and it's over a 4,000 square foot building, like just beautiful building in South St. Louis City. And Air DNA, and there's other tools out there that allow other investors to see what people are making on vacation rentals. And so my theory is people saw what we were making, and then they end up putting a whole bunch of competition on the market. So then the vacation rental in this niche got oversaturated, and that 14 grand a month that we were making slipped down to 9, slipped down to 8, slipped down to 7. We got hit with some, it's over 100-year-old home. We got hit with some bills too. And then what turned out to what we thought was going to be one of the best investments we ever made. We were kind of scratching our heads 24 months later saying, man, like what's going on here? Why are we losing money on this deal? So one of the weaknesses with vacation rental is it does not mesh. The supply and demand is its own it's its own supply and demand, and you don't have control over how many other investors are going to come in and potentially flood the market. Okay. And one of the strengths with real estate investing too is it can diversify yourself out of what's going on in the overall economy and the overall stock market. 3 out of the last 5 recessions, home prices have appreciated, for example. Real estate typically, I get in 2006, it didn't, but real estate typically performs really well in recessions. So it's a good diversification play. But if you're in vacation rentals, okay, what's happening? Well, you're relying on what the travel industry is doing. And the travel industry is very much reliant on what the overall economy is doing, right? So, as you think through these deals and whether to do them or not, uh, like I share this with you just as insights into how a guy that's done a few thousand deals over the last decade and a half. It's just kind of like how I think and how I think through these deals and yeah, so we do. Yeah, we still have a couple of vacation rentals, but at one point we had 15, and now we're down to 2, I think. Um, we have a different strategy we prefer more now.
Sure. And so with a fund, if I was looking over a package to decide if I wanted to invest in it, would that fund typically have like a target? Like, so we're doing single family flips, we're doing single family rentals. I know with the syndication, like we talked about, it would be like we're approaching this specific deal. Like, this is the location, this is the demographics, this is the job growth, this is the vacancy rates, that kind of stuff. But with a fund, tell me how you would know that, if you do want to avoid vacation rentals, how would you avoid that?
Yeah, it's just finding operators like so us we love a lease purchase strategy. That's what we do. And like so you mentioned like, well, how do you so our first fund we were targeting 37.5 million of them. And like the strategy that we were putting all the properties in is a lease purchase strategy. And uh and then ask me the question one more time because I feel like I'm missing a part of it.
Oh, so what would you give me to explain? So it would be, you would say that this fund is going to be specifically only for lease option strategy. It would kind of outline what type of property you're going for, and the projected returns.
Yeah, and then so you just kind of outline what the investment thesis is and how you're helping people, what the demand is from the market, and then maybe some of the risk mitigants and how you're lowering risk um, and then just the goal is that I think on any investment we should be very clear on what the investment is and feel like we understand it. As real estate agents, I think we really underestimate the value of our real estate knowledge, and and we'll the especially the ones that have been around a while that are kind of the quote unquote millionaire agents that are making a lot of money. Well, you know real estate really well, and just because your financial advisor may talk to you about these index funds and all this stuff that's over your head, doesn't mean that you can't still. I mean, real estate's made investing has made more millionaires than just about anything. I mean, probably anything. I don't have the stats behind that. And as a real estate professional, you already understand it at a really high level. So you can lower your risk when you really understand something quite a bit. Like I don't for me to invest into okay, well here's something. So I got approached by a friend that was in a mastermind group for 3 years, and in this mastermind group you spend 2 full days with people in a room, you share intimate everything. Like you get to know these people better than sometimes your family that you know. And for 2 full years I had an individual promoting his oil investment with me and wanting my business partner and myself to invest into this. And very successful guy, very uh, everything checked all of the boxes. But when he explained it to me, I just couldn't wrap my head around how the heck it worked. It's just not clear to me. And I end up saying no on the investment, and not because of the individual. The individual completely passed my test. Well, turns out that the whole thing was like a Bernie Madoff complete scam.
Oh no.
Yeah, and they raised like 2 or $3 billion for it, or just something
Wow.
ridiculous. The returns on paper were incredible, but they were taking new investors' money and paying and kind of pimping up
Right.
returns for the old investors. And I mean, so that, I mean, that's the importance of clarity. The clarity part saved me. That
Right.
like just because I just wasn't fully clear on what the investment was, and it turns out my he was a friend. I actually would still consider him a friend because, as it turns out, it looks like he was defrauded too. Like, so he was promoting something that the fraudster kind of like fooled him on too. So he kind of put his reputation and name on the line, and unfortunately, uh, unfortunately, he was wrong too, and got really hurt too. But so I mean, there's definitely like yeah, there's risks. There is risks there, um, but yeah, I mean, when you're already know and understand real estate, you get the right company, and like you understand the strategy, it becomes a great opportunity for that quote unquote replacement income that you have. And uh, but I mean that is the weakness to investing, by the way. Like if you're going to do all the work yourself, like there's nothing passive about it. I know people are online promoting how passive it is and how you can generate passive income, and it's unfortunate because real estate's a recurring revenue business model. And recurring revenue takes time to manage. It takes time to set everything up. The fortunate thing, though, is that these structures, these syndication structures, and these real estate fund structures, when you have the right strategy, you have the right team that you know, like, and trust, it really, truly can create passive income. It can create financial freedom. And it's not because the widget's passive. Like we're working every day on this thing, right? I mean, it's that I think you mentioned the book Who Not the How, and some of y'all have maybe listened to it, but um, other if you invest with other people, they can make it passive for you.
Yeah, it's really at a much bigger scale than getting something like a property manager. Like it's so if we're looking at the syndication model where you're looking at just one deal, let's say it's a multifamily property in Austin, Texas. You can really get into the details of and usually you get a report on this property that's going to explain how the demographics of everybody, why this is a good deal, why there's opportunity, and most of these there's an angle at all these properties. So like with a multifamily deal, it's probably they're looking to increase the value by increasing the rents, by improving the property, by having better management, by reducing the fees, all this stuff, making the playing the game with the cap rates to basically flip this big deal, get a ton of equity in this new thing, and then do a capital event, which means they're going to refinance the apartment or sell it. And at that point, there's a bunch of different ways you can get paid. Usually, you're getting a preferred return along the way on your initial investment. Then on this capital event, you either get your money back. Sometimes you get, like, if they're selling it all together, you get whatever the profits are. So doubling your money is not unheard of. It's not guaranteed, of course. And then if you're getting just refinanced, you might retain some ownership in the property and get your initial investment out. Which is all great, and that's why it's so passive. You can really, like you said, understand the deal. You can understand why this is good, and trust your operator. So you're analyzing the deal, you're analyzing the operator. Those are your main jobs, right? Um, and then the thing that we haven't touched on yet is the tax advantages of doing something like this. Now, are you able to get a K-1 with a fund as well?
Yeah, that's how. I mean, when we get into the tax world, I'm not an expert at it. I've tried to get my CPA to like answer all these questions for me, and the problem is each person's situation can be a little bit different, and I'm not licensed to like give full fledged advice. So that's the can't answer. And my CPA is like, "This is how you respond to this, Jim. You have to do this." But pragmatically, how ours works is it's the same benefit of whether it's your deal or not. You get depreciation on it through a K1, but instead of getting 100% of one property's depreciation, you're getting 1% of 100 houses. And, and with the difference of you're not doing any of the work, you're just taking the K1 and then giving it to your CPA and having them deduct what you owe on taxes because of it.
So most people that are familiar with investments would understand that you would take the structure value minus the land value and then divide that by 27,
Mm-hmm.
and that would be what you could depreciate every year on your taxes. As a tax professional, and again, same disclosure, I'm not I'm not a tax professional. If you're a real estate professional, is what I'm trying to say. You have some extra advantages you might be able to take advantage of, and that could be. If the property is doing accelerated depreciation, they
Mm-hmm.
could reduce your tax liability by a lot more. Just to give a quick example, I invested $50,000 in a syndication, and I got a K1 of about 66,000. So I was able to reduce my taxes by 66,000. And that's just my personal situation. That could be different, in your situation, like you said. You would have to talk to your CPA about it. But that is one of the things that I want to shout out off the mountaintops, as because I don't think many realtors really understand that they are real estate professionals and what the benefits of that for taxes are. And your services, investing in real estate.
So did you guys hear that? Like how powerful that is? So you owed so you had to pay $67,000 less in taxes because of
With a
the investment.
$50,000 investment, yes.
Can you say that one more time? Like, are you guys hearing this?
Yeah, I invested $50,000, and I'm getting a preferred rate of return on that, better than I would in some kind of money market, right? I'm getting good return on my investment, which is basically what most people hope for, right? But then on top of that, I got a K1 that allowed me to reduce $66,000 on my taxes.
Wow.
So that is maybe lucky. This was a mobile home park, and I think that there's probably a lot more depreciation on the first year than maybe some other projects might have.
Mm.
And I'm not expecting that again this year. But if I were to continue to invest in these things, and mind you, in a little bit of time, that money is going to come back to me that I initially invested. So if you keep piling up these kind of deals, you see the power
Mm-hmm.
in the syndication if you're a real estate professional, and that's why. Now, that's one of the big reasons for this podcast. I
So,
mean, just
so if you weren't a
educating.
real estate professional, what would that have looked like? Have you ever ran those numbers?
I do not have any idea, to be honest, because I think I would still get a K1. I think I would still get a K1, but I don't think I'd be able to take advantage of that full amount. I don't think that the amount would be different. I just don't think I would have been able to take full advantage of it. So I don't know what that would look like.
Yeah, and then there's also nuances on like so a lot of people don't know you can invest IRA money into real estate.
Yeah.
But like so if you invest IRA money, you're not getting taxed on any income that comes up. So like the depreciation doesn't really benefit you. Um, but it's also kind of sweet to be able to say, well, yeah, IRA money, I don't have to just invest into the open market. I can invest and generate passive income through IRA money that one day I can live off of when I'm no longer have my income.
Yeah, absolutely. And I know that some people are hesitant to go all in on real estate. But I mean, another way to look at it here is like what other opportunities are you able to leverage your what you're investing in? Like, so if you're buying $500,000 worth of stocks versus $500,000 worth of real estate, you're going to only put $100,000 into that real estate. You're going to put 20% down. Now, let's say that both portfolios go up by 20%. How much money? What is your return on both of those? So they're both worth $600,000 now, but you made 20% on your $500,000 investment in stocks, and you made 100% of your $100,000 investment in the real estate. I don't know if I explained that well, but that's one of the reasons. I mean, these are the reasons why I'm not fully all in on real estate, but I understand more and more why people are.
So what else are you in on if this is not all real estate?
Yeah, no. So I've done SEP IRAs, and so Roth IRAs, those kind of things, and I'm considering there's another tax strategy that I think is interesting. That if you're able to reduce your taxable income by enough, you can convert your traditional IRA into a Roth and not have to pay the taxes on it. So if you're essentially negative $20,000 in your taxes, you could convert $20,000 into your Roth IRA and not have to pay like the capital, like because it's tax free when you pay into the traditional, and then you would pay taxes on the Roth. So you usually would have to pay taxes on that amount you transfer over. But again, not a tax advisor, so definitely talk to a tax strategist or somebody before you try to do that. But if you're looking at, having some significant depreciation from these strategies that we just talked about, you might consider doing something like that. And then you can do a self-directed Roth IRA, or just have that in stocks as like a balance, where you can, just let it grow tax-free.
Yeah, investing, like I believe in the concept of diversification, and the funny thing is, and I'll tell people, yeah, I think you should diversify, and then every time it's time for me to diversify, I buy more real estate. I got like 95% of real estate, and it's been hard for me. I mean, I do have a pharmaceutical investment and some other stuff as well, but
Well, I think it goes back to what you're talking about, understanding it, right? Like, I mean, it's very easy to understand, and it's a very safe thing to invest in overall. Like, I mean, because everybody needs housing. So if you understand your market that you're investing in, and
yeah, that's right. And I think that's really where I come back down to is you look at like Maslow's hierarchy of needs, and food and shelter are like your basic two, right?
yeah,
And if stuff hits the fan and like the craziness happens, well, like we still have to have a roof over our heads. And so, like, to me, it is a less risky, or I'm talking about single family real estate here, by the way.
yeah,
Like, there's
yeah,
different types and all that, but because it fulfills that most basic need, push comes to shove, and I have a storage unit and I have a roof over my head, and I can only pay for one. I'm going to pay for the roof over my head, not that storage unit. I'm going to have to let the
right,
stuff that I think I needed that I don't really need. I'm just going to have to let that go, right? And
right,
um, so, like, I really like that, and as a foundation uh, for my own personal net worth. And part of my problem too, guys, just so you know, I do have we have enough real estate now to where diversification probably starting to make sense for me, but we're in a housing crisis, and housing's really short. And NAR did a study over the last decade: 5 million houses should have been built that weren't. And then Harvard did a study that they believe this housing shortage is going to last through 2038. So
wow,
anytime I look at buying anything else outside of real estate, like, it's like, well, like, this is just such an amazing buy and hold long-term opportunity right now.
clear
And,
upward pressure,
and the way we do it, we've mitigated our risk. We have higher cash flow and lower overhead than what a normal landlord takes on. Um, and like, so when I look at when we factor in what our risk is compared to what our returns are, and I haven't been able to find anything that beats what we can do, because of that. And now here's the deal. I mean, it's taken us 18 years or whatever, 3,000 plus deals, whatever the heck it's been, um, to like kind of develop this and refine it and master it. But um, it's, so like, I mean, I'm going to believe in diversification and talk about it, but it might be through the next 14 years, I may not be actually diversified. And then I'll start, okay, then now it's time to start branching it out. But I mean, it makes sense, guys, like how common sense investing in real estate is right now. If you think about it, my family would always talk, my parents are baby boomers, and they would always talk about all the wealth that was created because of the baby boomer generation. But if you look at that demographic, baby boomers are gigantic. And then the following demographics were much smaller. And now you fast forward to the baby boomers' children, right? And millennials are a little bit bigger, not crazy bigger, but they're a little bit bigger than what the baby boomers were. And then Gen Z's following millennials are almost as big too. So we have two gigantic baby boomer-esque generations that are entering into the housing market, that are first time home buyers now, that are creating demand for housing, right? And then on top of that, we have construction, where one in five construction workers are over the age of 55 and retiring. These young Gen Zs and millennials, most of them, we weren't doing trade schools, which, I mean, my goodness, trade schools have to come back for these, for our kids. Like, we need
yeah,
people that
please,
know how to build things with their hands. And now we have no one to build we have all this demand, and we have very few people that can actually keep up with it and build stuff anymore with our hands. So
And so many people got out of it with the last recession, with the bubble burst.
yeah.
And so there's just, like you said, this huge lag of how many houses should have been built to keep
Yeah,
up.
so from an investment standpoint, where my head's at is like, well, this is kind of a common sense thing. I just want to buy and hold on to what I can right now, and we have a group of 130 people that agree with me that we're just doing it together, and we're doing it in a way that has mitigated our risk to make it very unlikely we can lose anything, and just gonna enjoy the shortage for a little while and
Yeah.
take advantage
Yeah.
of
I mean, you're diversifying. You probably have red houses and blue houses,
it.
maybe a
Yeah,
couple white in
yeah, that's
there.
right. That's right.
So, I mean, if you want to really quickly mention your lease option strategy,
Okay.
um, we covered, somebody did mainly that in another podcast, but if you want to just explain at a high level what that is for people that don't understand.
Yeah, so what we do, rent to own is like another name for it. We technically do lease purchase, but it's a similar concept as rent to own. There's nuances that are different, but anyway, so what we'll do is we'll find someone like maybe a small business owner. I myself could have been one of our clients, and we'll say, hey, you have the money, you can afford to put down 5% for a home, right? And they looks at it, okay, $300,000 house. Yeah, I have $15,000 I can put into it. Sure, yeah, I can do that. Well, instead of renting, do you want to be a homeowner? It's like, oh, well, yeah, that sounds amazing. So we're opening up the American dream of home ownership to someone that maybe just doesn't fit into a traditional lender's box the right way. Every single small business owner in your first couple of years of being a small business owner, like you're not able to get a traditional loan. Every single one of us. And then there are some that, after 4 or 5 years, maybe the money's there, but uh, maybe they're a landscaper and they bought additional trucks with the profits. And so they reported a zero profit, even though they didn't have to buy those couple extra trucks, but they did because, that's just, they needed them long term anyway. And so in many cases, there's small business owners that, like, well, if they owned the home, maybe they would have bought one less truck and they would have just taken that money to pay for the roof over their head, right? So there's an entire demographic of people that we can serve and feel good about serving. One of our first clients has a special needs child, and the special needs child had to have a school district called Lindbergh's School District, and they got behind on medical bills because their special needs kid got sick. And so that dinged their credit. When we crossed paths with them, we said, well, hey, like you need Lindbergh schools. You don't have your kid doesn't have 7 years to wait for their credit to repair. That's all of grade school, basically. Um, and Lindbergh schools has like no properties to rent because it's one of the most sought after areas in all of St. Louis where we're at. Well, instead of just even renting, why don't you be a homeowner? Why don't we get your kid in the school district that they need? And so, like, we get to feel amazing about some of the people we're helping and serving. So they're winning at a really high level. And on our side, we're as an investment, we're winning at a huge high level too, because, they're putting 5% down. So imagine having a tenant that has 15 grand of investment into it before they move in. That's a lot of skin in the game to take care of a property, right? And then they're also, the way we structure it is they pay for all the repairs and maintenance. So if the roof leaks and I own a home, I call a roofer. I don't call whoever my lender is, right? And so I mean that's really the structure that we set up. And I mean there's a lot more to it that we don't have time to get into.
They're paying
Uh,
rent, and that covers the. I would imagine you're getting a mortgage on
mhm.
it.
Yeah, and there's a lot to it. There's a tremendous amount that goes to finding these people. So
Yeah.
I almost didn't do this strategy because one of my hiccups was like, are there really a lot of people that have a need for this that don't fit in the traditional box? And sure enough, I was wrong about that. It took us a couple of years to develop a company called Homeways that we really have marketing and the education and the conversations around how to educate people that think they can only rent, that no, you can be a homeowner too, and
Yeah.
a lot that goes into that piece of it. I tell you, once you get it dialed in, I mean, we had in our first fund, it was over 100 properties, and the number, I think it was like $4,500 in repairs and maintenance in 3 quarters of 2023. And I have 2 properties that are outside of the fund that are duplexes that don't fit the lease purchase model well. I got hit with 20 grand on those 2 properties. That's 2 versus 100, and I paid 5 times more in repairs and maintenance, right, on just 2 properties. And so there's a lot of amazing things that go into it too. But I mean, I think the biggest disadvantage with it is like if you do have a full time job and you're looking into strategies to do, I personally, I could not have pulled it off part time. Like, I mean, there's a lot, like it's an amazing, it's higher cash flow, lower overhead, lower risk than what a normal landlord's used to taking on. But because it's a little bit more intricate, like you really have to get the right who's in your world and get the right people to help you pull it off. Uh, but the good news is that there's companies like ours, and I'm sure there's other ones out there. I don't really know of a whole lot, but that you could do this through too. Like, you don't have to do all the work if you have capital to invest and are looking.
How could people reach out to you to invest in this type of thing? What websites? You mentioned one before. Is that the one they would go
Yeah.
to?
So when I'm on podcasts, so just Jim Manning, if you remember my name, JIMMANNING.com, has the ability to kind of schedule like a call and get more information on it. I have a couple free courses on there too that you can get access to. One's called Passive Profits, and it teaches you how to be a passive investor and helps you break down should you be one or not. Um, and then I also have a generating passive income course on there that breaks down. So we've used really 3 strategies to generate over $10 million in passive income here recently. And this is 100% passive income, guys. This isn't like the quote unquote passive income theory. And then I just took on another business. But so we did that over the $10 million, and I broke down my personal 3 favorite ways to do it in the course as well. And then, so if you want to get a hold of us, like I'd recommend you going there and kind of filling it out, and we can help you. Uh, if you're looking for an investment, or if you have a rental property that you'd like to turn into a lease purchase deal, we can kind of talk to you about that. And I also have a podcast, Passive Wealth Show. Um, we just you can kind of YouTube me and find me that way too. But
And I'll link stuff in the show notes so people can look there.
yeah.
We got to ask as well. Do you have a favorite book that you would recommend listeners?
Yeah, so I'll go with one that's not as commonly known. It's called Relentless Solution Focus, and a sports psychologist. It's I think it's Selk, Dr. Jason Selk, I think. Don't quote me on his name, but anyway, he's a sports psychologist and has had a lot of success. He worked for the Cardinals one of the years they won the World Series, I think in 2006. And what it helps you do is we've all been like in that rudimenting headspace where like the sky is falling, and it's like you just get like anxiety and stress and like aren't really getting what you can get done, and then almost feel like, I know when it's happened to me, I felt like dumber when I'm in that headspace. And what's nice about the Relentless Solution Focus is it kind of teaches you, okay, how do you snap out of that? And then how do you get into that positive headspace? Because like I know when I'm in the flow of things and like things are going well and I have all that momentum, like it's an incredible space to be in. And what I love about the book is it kind of breaks down like why it happens when you're in a slump, and it also gives you like a formula and um, a way to make it more likely for you to kind of stay in the pocket, in the zone, whatever you want to call it. But yeah,
That sounds
a neat,
interesting. I'm definitely going to
neat
read
book.
that.
Yeah, it's a neat book for sure.
Cool. Well, I really appreciate it. This has been a really interesting conversation. Hopefully, we have inspired at least one agent maybe to start getting into the investment world if they aren't already. Yeah, thank you so much for being here, Jim.
Absolutely. Thank you. And hey, guys, appreciate you. I hope you have a great rest of the day. Take care.
Thanks for listening to the Wealthy Investor Podcast, where we talk about wealth and holistic health. If you enjoy our content, subscribe wherever you get your podcasts to hear new episodes every Thursday. If you really like our content, you can follow us on social media at The Wealthy Investor, wealthy spelled W-E-L-L-T-H-Y.